Thank you for joining us. My name is Ted Stolberg. I'm the co-founder of Beanstalk Collaborative Community Wealth. And my business partner is Diana Crabtree Green, who's been our chief financial officer for a number of years. And so what we're going to talk about today is Money Matters, valuing your manufacturing business. So, and we're going to do that in the context of what are the different kinds of buyers and how can you make yourselves attractive to those kinds of buyers. So a big part of this is going to be, how do you enhance your purchase price? And what are your goals and objectives? So Diana, do you want to talk a little bit about your background?
Certainly. Hello, everybody. Great to meet you. I am a CPA. I started work as an auditor with PricewaterhouseCoopers, so Big Six accounting at the time, and then went out to the private equity world, which is when I joined up with Ted. Ted and I have been working together for a couple of decades, and now I do a lot of things, but as he mentioned, I'm the CFO for BCCW. Great to be here.
And you know, that's an important function because we have a saying, you're going to hear a little bit today, is, you know, if you can't measure it, you can't control it. So if you don't have, you know, good financial systems and a quality financial officer, it's not good. It's not good. Yeah. So at a high level, you know, this can get really confusing. You know, it's complicated, it's confusing. And as an owner of a manufacturing business, the problem is you got a lot of people talking to you, and they're all talking to you in their narrow little silos, which can be really troublesome. So, you know, you got the business broker who wants to sign you up to an exclusive, which is fine. You know, they want to get the highest possible price. They're going to tell you every buyer's great. That's not necessarily true. On the contract lawyer, well, here's the problem. One of the things we see is that sellers oftentimes use their existing counsel to do a merger and acquisition transaction. And that's really a terrible mistake because it's a real specialty. So, you know, you may have your lawyer that does your contracts with your customers talking at you about a merger and acquisition transaction. That can get very, very confusing. Buyers are going to tell you what you want to hear. Your management team is going to have lots of concerns about what's going to happen to us, who's the buyer, what's my role. Did you want to talk a little bit about the accounting side, Diana?
Certainly. So another tendency is to think that your fantastic CFO or CPA on staff is going to be adequate to help this M&A transaction. And the fact of the matter is, the best accountant in the world for you, for your operations, is probably specialized in your operations. So make sure you understand the limitations of anybody on your team and reach out and get some real experienced experts. And then family members oftentimes are part of your company as well. And you might be trusting your kid, your cousin, your sister, your uncle, whomever with a lot, and they may be capable, but again, understand their limitations and get that help where needed.
Yeah, great. Yeah, a little bit of the, you know, a little cautionary tale on the bait and switch. You know, it applies to buyers, you know, a lot. Corporate buyers, financial buyers, private equity buyers, individual buyers, they're all going to tell you what you want to hear. And so you really need to cut through that and find out what their economics are, how they work, and make sure you don't get trapped into this bait and switch. And we're going to go through this in gory detail a little bit about different types of buyers and what their motivations are. That's what you need to understand. So also, as you said, things are complicated, but we're going to really try to simplify this and get it down to some basic things that'll help you understand how to value your business, how to increase that value, and how to understand what buyers, what the different kind of buyers are, and what are they looking at, because then you can really make better decisions. Yeah, and so, you know, valuation's a lot more than purchase price. You know, it's as you know, as they say in taxes too, it's not what you get, it's what you keep, right? So this is, again, what Diana and I were talking about. It's very important to get the right merger and acquisition counsel and tax accountant that understands mergers and acquisitions. Because, you know, there's cash at closing, and then there's seller paper where the buyer says, hey, I couldn't get my financing. I need you to carry $2-3 million of subordinated debt underneath the banks, by the way. There is an escrow agreement, very common, 18 months. That's going to back up your reps and warranties, the representations and warranties you made. There's a working capital adjustment. That's where you set the price on an asset deal, but it adjusts 90 days later, depending upon is working capital increased or decreased. And then there's recapture tax, which Diana, why don't you talk a little bit about that? Because this can really get ugly.
Yeah, so just with the sale of any investment that you've got, of course, you've got capital gains. But if you've had substantial depreciation over the years on your assets, you're going to be paying taxes at a higher rate than you may anticipate. So again, with the importance of having a very experienced CPA, tax accountant on your council or on the team as you go through this, you want to understand what you're going to be keeping in the end, and not just what you're getting with that price.
Yeah, so a lot of these transactions will be asset deals, right? And so the purchaser will come in and allocate for tax purposes to, say, your equipment. And if it's been depreciated, let's say it's depreciated to $1 million, but the fair market value is $3 million, you got $2 million of recapture tax. That's ordinary income. So it's really critical, really critical. And then we talk a little bit about this too, before you go on this journey of money matters, what is it that you're trying to accomplish? Do you want the highest price? That's fine. The upper left-hand square here, you just have to figure out which buyers are going to give you the highest price. And are you ready to receive the highest price based upon, what you've done with the business? Or do you say, critical for me is my legacy, my employees, my community, probably not going to get the highest price. That's going to adjust your goals. And sometimes you may end up in the middle, which is the bottom box here, which is, hey, you know what? Within reason, I want my legacy protected. I want to take care of my community. I want to take care of my employees. I want a fair price, not necessarily the highest price. So think carefully about what your goals, because that's going to drive you. It's going to drive you to what kind of buyers you want. This is a big emotional decision too. I don't know.
It is. And one thing you didn't mention is morale. Like really pay attention to the morale that's going to remain in the company after you sell. And it might not be the highest price buyer that's going to create a situation to really nurture your employees and continue that business in a way that's really going to keep it successful as you want.
No, that's right. If you sell it to Attila the Hun and the guy comes in and starts slicing and dicing and pulling out synergies and cutting costs, we always say, it could be kind of hard going to church with your employees, right? Mm-hmm. You're doing high fives because you got a high price, and the employees are like, what happened? So you want to think about those things.
Yeah, it sounds painful.
We want you to switch a little bit to the seller. Think about the seller. And I always laugh. My college defensive back coach, Coach Fisher, who I really loved, he had this thing he did to me once. So I was a defensive safety. So I'm lining 15 yards deep. I don't want to get beat for 6 points on a touchdown. First of all, it's awful. Plus, everybody can see that you got beat for 6 points. And so I'm playing defense. He goes to me one day and he goes, change your mindset. Okay. When the ball is in the air, I want you to say to yourself, oh my God, this quarterback has done such a stupid thing. He threw the ball in your zone. Really dumb move, because that's your ball. Okay. That's your ball. I mean, totally switched my whole game. I went from playing defense to offense, and it just was a lot better. So,
well, it's the idea of a job interview too. Don't walk in ready to talk about your strengths. Walk in telling them how you're going to change things and make things better for them. Right. Right.
How they can. Yeah. I'm here. How am I going to add value to your company? What can I bring to the party? Yeah. It's great. Choose the buyer. Right. So let's start with the top. There are corporate buyers, and then there are private equity buyers that have a platform company, which means they're adding on to it. They have synergies. Okay. They're going to be able to cut costs, maybe add some revenue items. Because they have synergies, they can pay you the highest price. That's a fact. In terms of legacy and employee protection, forget about it. It's not going to happen.
So this is where the morale may suffer.
Yeah. It's just don't. And they may be telling you, hey, we're great. We're going to keep the plant here forever. You're going to love us. We're going to take care of your employees. Don't listen to any of that. Then you have the individual and the ESOP. We kind of lumped them together to keep things simple. So there are individual buyers. We'll talk about that I mean, these are executives that want to buy a smaller company and run it. And then ESOPs, very complicated. Haven't seen it work a lot. You're not going to get the highest price. In fact, in many cases, you're not going to get a fair price because the ESOP doesn't have any money. The individual doesn't have a lot of money, and they're going to leverage it to the hilt. And frankly, you're probably going to get the lowest price.
And ESOPs are sometimes referred to as co-ops. I've heard them.
Yeah, well, co-ops, employee stock options. Yeah, it's essentially where the employees have an important say in the business. Legacy protection, employee protection, community protection, forget about it. No, not going to happen. They're buyers like ourselves. We call ourselves a community wealth builder buyer. We basically say we're never going to resell it. We're going to keep in the community. We're going to protect your legacy. We're going to take care of the baby for you. Fair price, probably not the highest price because we don't have the synergies. So there's a bunch of valuation techniques. Diana and I, we're not going to make it complicated. They're really, really three real ones and one that we don't even want you to talk about. But you liquidate the business, you take the present value of the future cash flows, which we're not going to talk about, too complicated. It's a projection of your free cash flow. You put a terminal value on it, you present value it at a discount rate. Yeah, academically, it's correct. Too complicated, not very practical. Merger and acquisitions and comparables are very important. So companies similar to your size, your development, your growth, your margins, your systems, your people, that's going to be important. And EBITDA multiples. And, EBITDA multiples are earnings before interest, taxes, depreciation, amortization. A lot of people argue about that. Warren Buffett would say never use an EBITDA multiple because the depreciation and amortization is going to get spent in capital expenditures. So he doesn't like it. There's some truth in that. But the industry generally circles around EBITDA multiples.
So which of these four is the best? You're saying that EBITDA multiples is the strongest valuation technique?
Yeah, I mean, Diana's making a good point. We ought to just keep it simple. Merger and acquisition comparables, EBITDA multiples. Let's focus on those to really make this cleaner and simpler. We never want this to come out of a seller's mouth, and you don't ever want to say it. My equipment has a lot of value. That's nuts because you want to sell your business as a going concern business, not my equipment has a lot of value. I mean, what you're really saying to the buyers, I'm not selling this based on cash flow and growth and margins and product. And just come in here, kick the tires, buy my equipment. Don't ever do it. Don't ever say it.
We did this last weekend when we had a garage sale. It looked a little bit like this.
Oh, yeah. Oh, no. Diana and I have this very sad picture, right? Here's these guys, tough guys at a liquidation, looks like they're buying, what are they trying to buy? Some sheep there? I don't know. It's a rough room. And this is what happens in equipment auctions too. There's under the hammer and then there's orderly liquidation. You're not going to get your price. You're not going to be happy. It's not going to be good for your employees. It's not going to be good for anything. The short version is on this, it's pretty much what your bank is going to do. Receivables, 65, 80% of value, finished goods, raw materials, inventory, 50%. Gross PP&E, this is gross property, plant, and equipment that we're talking about. This is rough. I mean, you can end up with 10 cents on the dollar. In orderly liquidation, maybe 120 days, maybe 20, maybe 30. The one thing that Diana and I always advise is if you have real property, if you own the plant, that can have a lot of value. That you need to bring in a real estate broker and get an appraisal because there can be tons of value in your land and the building that you own. So
that's about it. Sounds like.
Yep. So we're going to talk about the non-corporate individual acquisition. So this is the individual buyer of the ESOP. So, in our little example here, you got an EBITDA of $1 million, 10 million in sales, 10% EBITDA. Multiples for smaller manufacturing. Again, we're going to show you climbing the valuation ladder later on, but generally, 3, 4, 5, 6 times. So in this example, you get 4 to 6 times your $1 million, you get 4 to 6 million. And if you have debt on the balance sheet, by the way, it's going to be reduced for that debt. If you have cash, it'll be increased. So now we're trying to show you the difference between that and a corporate or private equity platform company buyer. So this, again, this is where they have synergies. And we've tried to reflect those synergies in the sales general administrative expense. In the previous example, there was 2 million. Here they cut your expenses by $1 million. Not unreasonable. And frankly, a lot of these corporate buyers and strategic buyers, they're buying it based upon the gross profit margin because they're going to cut everything out. So your general manager's gone, your accountant's gone, some of your supervisory staff is gone. A lot of people are gone, but they doubled EBITDA, right? So in the previous example, you got 4 to 6 million. Well, here they can be at a lower multiple and still pay you $4 to $8 million. So that's a really simple, silly example, but this shows you what synergies do for you as a buyer. But remember, they're going to take the costs out. Finding the right strategic buyer can be critical. I mean, Diana and I worked on a company, and we invested in a company called Alpine Access. They were a call center virtual. We had agents in the home. So we had ended up with 5,000 agents in their home. Many of them were very college educated women that were taking calls for high end, like the Amex Black Card. So these were high end. And this was our CEO, Chris Carrington. He came in, we were doing about 20 million in revenue. And he grew it to 50 million. And we were ready to sell the company. We had a private equity firm. We needed to sell the business. And we had one buyer called Sykes, a public company, strategic advantages. I mean, they had all these fixed call centers, and they could use our virtual center to do a lot of different things in terms of their load factors. It wasn't so much about cutting costs. There was some of that, but there was basically allowing them to load all their fixed call centers differently, right? They bid us 150 million for 50 million in revenue, making about, God, I forgot, Diana, I don't know, $3-4 million in EBITDA. The next bidder after that was 65 million. So this can show you the power of a synergistic buyer. And I remember being terrorized, thinking our investment banker was actually pushing Sykes a little bit on the price. I was like, stop pushing them. If they walk, we go from 150 to 65. So stop pushing them. So there's an extreme example of a synergistic buyer.
And Alpine Access, that's a company that was so far ahead of their time. I mean, this was 20 years ago.
Yeah.
Everything's virtual now.
Yeah.
Virtual, everything is.
Yeah. It was a nice business, and Chris did a nice job. So we talked about individual buyers. You're not going to get the highest price. You're not going to get your legacy protected. Again, these are individuals. They oftentimes use this SBA program called a 7A loan program, where they can put a lot of leverage in. They have to provide a personal guarantee, which is not I don't think is a good idea, but the leverage is very, very high. So basically the exec is kind of buying him or herself a job. They can't pay you a lot. The leverage is going to be high. The existing management, your general manager under you, the owner, may be discouraged because, like, who's this person? How are they going to work? And there's also a pretty high risk that you don't have a closing, or there's a delayed closing. Again, one, because they got to cut the price, and two, high leverage. So it's kind of a messy one. Be careful. So Diana and I jumped up and down. I mean, if you walk out of this presentation with nothing else, just one thing, it's hire a qualified merger and acquisition counsel, your lawyer, and qualified merger and acquisition tax accountant. Just do that. You'll be very happy you did that. And, we always say, look, if you don't know your diamonds, know your jeweler, right? And when, you've been running a manufacturing company, you don't know your diamonds. It's a merger and acquisition transaction. It's very, very different. You got to get your quality jeweler next to you. So let's talk a little bit about how to create value. How do you get more in your purchase price? And Diane and I call them value enhancers, right? And I want to give you an example. I don't know, many of you, I'm older than probably most people. So this guy, does anybody know who this is? This guy's Fred Belinkikoff. He was a receiver for the Oakland Raiders in the early 70s. My brother actually played for the Raiders. and was a receiver. So we played with Fred, and Fred was an all pro receiver. He's not that big, right? And he actually wasn't that fast. He was very shifty, and he never dropped the ball. I mean, it was amazing. So I want you to look careful. He had an enhancer, which, by the way, is illegal today. But back then, okay, if you look at his left leg on the inside of his sock, what do you see? It looks like dirt. It's stickum. It's stuff that he would reach down, put on his fingers, and allows the ball to stick. He could catch it better. Look at his forearms. That's tape. It's been reversed. The sticky side is on the outside, right? So the ball just creases it, gives it, stops it enough that he can catch it. He's even got a little bit on his knee here. This guy had stickum everywhere. And so that was his enhancer, okay? Kind of a funny, maybe silly example, but we want you to have some enhancers when you go out to sell.
But legal ones.
We call this manna from heaven. These are things that you can do. It takes some time, but you can do them that will really enhance your valuation with a buyer. And I'll just pick out a few, and Diana, God bless, please pick out a few. Reasonable balance sheet, reviewed or audited statements, really important, because what we get a lot and buyers get a lot is they get cash statements, right? They're not even accrual. They're not accrual, they're cash. We can't figure out, we and other buyers can't figure out what the real gross margin is. Is it after labor, material, manufacturing overhead? How did you account for the inventory? That's really important to buyers. And they're going to either drag you around till they get what they need, or they're just going to reduce the price. Customer diversification, a lot of manufacturers, if you've got one or two customers that control 50% of your business, it's going to take the price down. Growth is obviously a good thing. Late model equipment is not a good thing to the extent your equipment's up to date and you have certifications, ISO 9100. Cybersecurity certifications are great for aerospace today. Attractive margins, these are all good things.
Absolutely. Some of the yummiest lows, or manna, if you ask me, are the financial related ones. You really do need strong financials, as Ted mentioned. You need to make sure that your financials are consistent with GAAP, and not just right before you sell. You want this done well in advance. You do not want to be scrambling to change from a cash basis financials to GAAP in anticipation for a quick sale. Same goes with having a good controller or CPA on staff. You just want to make sure that your records are airtight. You don't want a lot of questions and a lot of ambiguity. You also want consistency between periods, because your buyer is going to come in and look at historical financials for several periods and several years, and they're also going to look to use that to be able to project forward for their modeling purposes too. So make sure your finances are in great shape and get it done sooner rather than later. If you're thinking of selling at any point in the future, start changing things yesterday. Get it done.
Yep, Diana's 100% right. And also, who's the management under you? I mean, if you've been a one-man band and there's no one capable underneath you, well, that's going to cost you in terms of valuation.
And one more thing with the financials, if you have not undergone a review or an audit previously, this is a great time to get it done, because your buyer's probably going to ask it, and those objective outside accountants coming in to look at your financials are really going to turn over anything that needs some work. Yeah.
And these MRP, ERP systems, they're really important. As profitability by product, profitability by machine, profitability by customer. These are really important things. And what we see a lot of is, Global Shop and others, a seller has implemented it halfway. It's not a full implementation. So they say, gee, I've got MRP, ERP systems. Not really. So think about that too, from a value enhancement point of view. And as Diana said, this plan ahead. She's right. Don't just pop in and say, I want to sell my business and, wow, we're going to do this in the next 3 months. It can take some time to get to the promised land, but it can be worth it. This can really dramatically change your purchase price. We have this thing called climbing the valuation ladder, and we've kind of we've talked about it, but just take a look at this thing. I'll just give you a couple of examples. So at the 2 to 3 times EBITDA, little or no accounting systems, as Diana was saying, the books and records, no review, no audit, one person operation, no management depth, no professional accounting staff. These things cost you in terms of multiples. Now let's go to the 5+ EBITDA, MRP, ERP systems, management, automation, good equipment, proprietary products, demonstrated growth, EBITDA margins, gross margins. We have sellers that say, boy, I'm really proprietary. I've got great stuff. We go, what's your gross margin? 18%. No, I'm sorry, you don't have proprietary. 35, 30, 35, 40, that's proprietary. So just take a look at this, study this chart, print the thing, put it in your wallet and look at it every day, because these kinds of things will dramatically improve your purchase price.
And don't be overwhelmed, because there are definitely steps between 2 and 5 times. So be ready to take the steps and be patient.
Yep.
Prudent and diligent.
What's interesting too, the more I hear ourselves talk, we're talking about money matters and improving the purchase price. But you know what? If you do these things, it's a better business. It's just a better business.
Of course.
So don't do it just to sell it. Do it for 2 reasons. One, I'm going to make my business better. I'm going to understand it more clearly, and I'm going to get a higher purchase price.
You may do all this and decide you don't even want to sell your business.
Yeah, exactly. That's a good point. Yeah. So this is our little propaganda segment where we tell you a little bit about our model. So, again, we're buying smaller manufacturing, kind of 3 to 25 million in revenue. The key for us is our operating executives, and our CEOs, Troy Roberts in the upper left-hand box, and Bill Smith, who built a business, Teramax, from, 4 million to $100 million in revenue. These are fabulous, seasoned operating managers. And that's really critical to creating value. And again, we're never selling these businesses. So it's got to work. We got to make them work. We got to compete in the marketplace, got to take care of our employees, got to take care of the community. So we say our model's about operating execs. It's not about 25-year-old, financial analysts, MBAs telling you what to do, and they've never run a plant. Conservative capital structure. Some of these buyouts, they're done at 5-7 times EBITDA on the debt side. Can you imagine that? And by the way, we're about to have a recession. So take a look at what's happening with inflation and interest rates. So think if your business is sitting there with, 5-6 times EBITDA turns in debt, and you have a recession, God help you. As we said, we're not going to resell it. We keep in the community. We're not sending the work to China. We're not sending it to maquiladoras. We want to protect the family legacy. We're not about strip mining these businesses and cutting costs out. We make operational improvements. That's really the value that we add. It's not about financial engineering. And as I said, we don't want to resell the business. It's not about private equity people. And I was one, so I'm a reformed smoker here. What they have to do is they got to generate 20 to 25% returns. They got to buy it cheap. They've got to take you to the woodshed on documentation. They got to jam 3 add-on acquisitions in there. They got to use a lot of leverage. They got to resell it in 3 or 4 years. That's the deal. That's the model. It is what it is. And if you don't perform and you don't do that, you're not going to get any money from your limited partners who are pension funds and college endowments.
So that's not what we're about.
Yeah. So we have this thing. We say, wouldn't it be great if no privately held manufacturing company was ever sold outside its community again? Your business is very important to your community. 2/3 of all new jobs in the country are generated by businesses with 25 employees or less. Think about the economic model of what happens when you pay livable wages to your people. We say that the data suggests every dollar in a privately held manufacturing company contributes $2.7 to its community. These businesses are very, very important economically and culturally for their communities, and we want to keep them there. Actually, if you were with us, we would pass out a 3x5 card that we would request you put this in your wallet. So since we can't do that, we want you to print this out, cut it, and put it in your wallet. So anyway, to summarize, match your goals with the buyer type. Whatever your goals are, make sure the buyer lines up with your goal. Please hire these qualified advisors. Tax accountant, M&A, merger and acquisition tax accountant, merger and acquisition lawyer. Go after the valuation enhancers. Go after those. We've talked about them. Call us if you have any questions about them. Email us. It'll make a huge difference. And Diane and I are sorry, but we're all going to die. And so you may as well start planning now. So we see a lot of owners, never come to that realization. But unfortunately, none of us get out of this alive. So that's there it is. Thanks very much for your time. Appreciate it. Take care. Have a good day.